let's go now to retirement. And the first chapter is about protecting retirement from market risk. So why market risk matters in retirement? Because market downturns near and during retirement can reduce your income. And then you have little time to recover from losses. So the goal is to preserve the principal, what you invest, and create guaranteed income, and of course, avoid stress. So let's go back to history. Why they invented the 401k? Because before 1979, most workers, they relied on benefit pensions like public service people, like firefighters, teachers, they have a pension. It was a guaranteed income funded by the employers. So in 1978, you have the Revenue Act from Congress. They introduced the 401k, tax-deferred employee contribution. And then the IRS guidance in 1981, they enabled salary deferral into 401k, and that's what you have now. The impact, you shift retirement responsibility from the employers to individual because you have individual account. So the impact, you shift retirement responsibility from the employer to individuals, and you have now the market exposure increase for retirees, replacing the guaranteed pensions. So this shift, early 80s, laid the foundation for Wall Street growth and greater retirement risk. And everybody remember this movie. What happened? 1981, 1986, a lot of cash is coming to Wall Street. Trillions going to mutual funds, fueling a historic bull market. S&P make 3.5 times the money in 5 years. And what happened in October 1987? The crash. The worst crash on Wall Street. Worse than 1929. Minus 22%. So if you have $100,000 January 1980, you grew to $296K by August 1987. But then you lose 23%. And then it will take you 21 months, almost 2 years to regain the prior peak, to regain your losses. So even diversify, because people will tell you, oh no, I diversify assets. Everybody has to do it, of course. You still suffer from losses. So probably you heard about this common retirement account. Let's go a little deeper here. So you have the traditional IRA, individual retirement account. So the contribution is pre-tax. It's tax deferred. So they will charge you the taxes when you withdraw, when you get retired. The Roth IRA is after tax. So you invest after you pay your tax income, and you will never pay taxes on this Roth account when you withdraw. Then you have the 401k, is also pre-tax, tax deferred, and is employer match. The last one is 403b, 475. It's for teachers, public servants, or also people they work in charity organization. So market risk explained. So you have market volatility is down, up, down, up. You have sequence risk. Bad returns early, withdrawal faster deflation. Then emotional selling. People are panicking, sell everything on Wall Street. And the recovery time. Big bears market can take years to heal. So Social Security for a lot of people is an income. Yes, it's just a floor, not a fortress. Because you have an average benefit for people is $1,900 per month. Can you survive $1,900 per month? So that you have the COLA, not COCA. It's the cost of living adjustment. You raise the checks every year on your Social Security, but sometimes it doesn't take really care specifically on inflation. And then you have benefits for your survival, of course. But you still need a stable, market-proof income layer beyond your Social Security. So what happened after the crash in 1987, they have to invent a new rule. So they invented a 4% withdrawal rate. So in 1994, Bill Bengen, it's the University in Texas, Thrifty in San Antonio. He looked at the 30-year period since 1926, and he found that the 4%, the worst case safe withdrawal for 60-40 portfolio. The 60-40 portfolio means that you have 60% in the stocks and only 40% in the bonds. The goal is to deplete, fully depleting assets, not maximize account. But your retirement account is for your future income, not to invest in the stock market. So the problem is never protected, and then people suffer from crashes. Remember 2008 was just like 15 years ago. The results, retirees must accept low payouts and risk running out of the money. So that's the reason why they're looking for higher protected income streams. So the key risk if you lose principal. We had the crash in 2000. I worked in Wall Street, I remember. You have the crash in 2008. You have the sequence of return, 20% loss, then you withdraw 50%, 5%, the break even is plus 3%. Free drag, because you have to pay the fees to your personal advisor and the banks, 1.5%. And it's 30% of your assets for 25 years. You have inflation risk, 3% inflation, but we had years with 10% recently. And yes, 25 years, 4% to 25 is 100. What do you do after 93 years old? And a lot of people are reaching more than 93 years old now, like my grandmother. So that's the reason why there are systems, they help you to lock when you have losses and you gain when you have gain. So that's the market protection. So you keep market upside but block the downside. So the tool set is fixed index structure inside an insurance chassis. It's like covering your car or covering your house. So it's 0% for annual gain lock-in, so your account never moves backward. And basically, you create your personal pension that won't shrink in bad markets. So what happened here, you have different aspects. You have the S&P 5 going up, down, going up, down. We have a normal 401k account. The black one is the fixed percent, 3% fixed if you have like bonds. And if you have the fixed indexed, it's what you have here. You never lose money here, and you continue to grow. So at the end of the game, you have 400k. And if you have only fixed bonds, you have 200k. So the hidden blueprint. We wrote an article, people ask us why this is too good to be true. But this is all financial institutions use it. These tools, they use options, call options to protect the index and the equity. So they have also bond sleeve. They invest in high quality bonds, like, I don't know, bonds, if Amazon deliver bonds or Microsoft, there is General Electric, and reserve reinsurance. They are protected also by other insurance products. And the client benefits is market link growth, principal protection, and lifetime income and death benefits. So just an example. You use the old rule of 4%, and you can Google, they will usually tell you, they will recommend you. But we can offer a 7.5% payout rate, and we'll explain why. So if you have these retirement savings here, if you have 4%, you have $500,000 in your account. It's good money, but with the 4%, you have $20,000 withdrawal per year. With 7.5% payout rate, you have 37. You have almost double the money. We can also have 8% payout rate too, but just to give an example here. Long-term impact. Annual income, the difference after 30 years for $500,000. Look, it's another $500,000. So you have $500,000 starting your retirement. After 30 years, you have $525,000 more income. Can you still access your money? Yes. Because you have the cash value access for emergencies and the penalty-free withdrawal above income stream after vesting. And there is no forced annuitization. It means that if you still have assets remain in your name, and not like the former pension, you pass away, the pension is gone. So the principal is protected. You have locking in gains. You keep your gains. And you don't invest in your gains in losses. So you have a lifetime income guarantee until 99 years old. And sometimes until 120 years old. And the inflation age, because the interest growth, and for market-only account, is only based on the market returns. And you can take care of your family. It's tax-free payout, or for market-only account, it depends on your balance. So just an example here. A couple, 67, 63 years old, they roll over $65,000 from their 401k. They're looking lifetime income for almost $50,000 per year plus Social Security. But then they maintain the cash value access. If there's something happens, they have cash value access, they can get access to cash. And then they have benefits, they have a legacy, an estate to give to the beneficiaries. Could be the spouse, survivor spouse, or the children. And market crash is no longer threatening a lifestyle. They can have a nice life. Stress-free is what you want in retirement. You want to look at, oh my God, I just lost $100,000 in the stock market, I have no control. So ready to step guessing. What we do, we map your current accounts. We do a stress test, because we have simulation software, against 90 crash, 1987, 2000, 2008 scenarios. And then you can show the side-by-side income with the RESO 7.5% plan. So the key is security, flexibility, and legacy.